Welcome to this deep dive. Today, we're going to unpack the latest results from Amber Enterprises India Ltd. Specifically for the quarter ending June 30th, 2025, so that's Q1 FY26. Our goal here is really to get past the headlines, pull out the key takeaways, and understand the strategy behind this pretty diversified Indian manufacturer. We're using their latest press releases, investor decks, board meeting notes, all the official stuff.
Exactly. And think of this as a kind of a shortcut for you. You'll get up to speed on how a major player is shifting gears in India's industrial scene. We're aiming for those aha moments, insights into not just Amber, but the wider market trends as well, because they're really changing things up.
Okay, let's dive right in then. What are the big consolidated numbers for Q1 FY26? Revenue first.
Right. Revenue came in at 3,449 crore. That's a big jump, 44% growth compared to the same quarter last year on year.
Wow, 44%. Okay. And profitability.
Operating EBITDA.
Operating EBITDA hit 263 crore, and that's up 31% year on year.
And the bottom line, profit after tax, BTT. PAT was 106 crore. Also strong growth, 42% year on year.
So strong growth across the board. Their MD, Mr. Daljit Singh, actually called it a robust performance. Seems fair enough based on those numbers.
Yeah, it really is. And what's fascinating, I think, is how they achieved this. Look at the PT margin. It held steady at 3.1% year on year.
Okay.
But their gross margins actually dipped a bit, from 17.8% down to 15.7%. So about a 2.1% drop.
So stable profit margin despite lower gross margin. How does that work?
Well, it signals they managed other costs really effectively. Operational efficiencies, maybe changes in overhead, something like that. It shows real agility, especially when your input costs or pricing might be under pressure. It's not just about selling more.
Makes sense. Okay, let's zoom in a bit. How about the consumer durables division? That's still their biggest piece, right?
It is, yeah. For Q1, revenue there was 2,560 crore. That's a 33% growth year on year.
Still very solid growth.
Yep. And the operating EBITDA for durables was 192 crore, which is up 28% year on year.
Now, I saw in the commentary they specifically mentioned this was achieved despite a challenging RAC season. RAC being room air conditioners. That seems, well, counterintuitive. How do you grow 33% if your main market is challenging?
That's a great point, and it really underscores their strategy. It's about diversification within that division.
Okay.
It's not just finished ACs, though they make the whole range: split, window, inverter, cassette, you name it. A huge chunk of their resilience comes from making components, not just for ACs, but also for refrigerators, washing machines, microwaves, water purifiers, even components for cars and energy meters.
So the component side buffered the weakness in the finished AC market.
Precisely. That broader base makes them less vulnerable to swings in just one product category like RACs. Plus, they mentioned strengthening their light commercial AC side. They onboarded a new MNC customer, that's always good news, and they signed a 3-year deal with GMCC for compressor supplies. That points to deeper, sort of stickier customer relationships providing stability.
Right, these aren't just quick sales. These are structural things.
Exactly.
So for you listening, why does this matter? It really shows how a company can build resilience. Diversify within what you're good at. Build those long-term ties. It means you can navigate bumps in the road, like a tough AC season, much better. Okay, now, you mentioned things are changing. Let's talk about the electronics division. They use the term transformational growth. That sounds big.
It really is. This is where things get particularly interesting, I think.
The numbers certainly suggest it. Revenue was 766 crore.
Yep, 766 crore. And that's up an incredible 97% year on year for Q1, almost double.
Wow, okay. And the operating EBITDA?
That grew to 49 crore, which is a 62% jump year on year, still very strong growth, even if the percentage isn't quite as high as revenue.
So nearly 100% revenue growth.
Yeah.
What's driving this transformation? What are the pillars here? Is it sustainable?
Well, connecting it to the bigger picture, it's definitely a strategic overhaul, and it's happening on multiple fronts. First, there's the policy angle. They filed 2 applications under the government's electronic component manufacturing scheme that's run by MEAD.
Okay, the government scheme, what are they applying for?
One is for multi-layer PCBs, printed circuit boards, through their company Ascent Circuits. That's projected at roughly 990 crore over the scheme's life. The other is for more advanced PCBs, HDI PCBs high-density interconnect, through their joint venture with Korea Circuit. That one's much bigger, projected around 3,200 crore.
So big bets on domestic PCB manufacturing supported by government incentives.
Exactly. It's about building that local electronics ecosystem.
Oh.
And they're putting their money where their mouth is. Second, they're building capacity. a big new facility in Hoser. Phase 1 is a 650 crore investment.
When does that come online?
They're expecting commercial production to start either late this fiscal year, Q4 FY26, or early next, Q1 FY27. So within a year or so.
Okay, capacity expansion. What else?
And this is maybe the most significant part. Strategic acquisitions, really transformative ones. First, end of June, they signed a deal to buy a majority stake in Power One Microsystems.
Power One. What do they do?
They're right in the sweet spot of energy transition tech. Battery energy storage systems, BSS, solar inverters, EV chargers, UPS systems. And importantly, Power One apparently have quite healthy EBITDA margins, around 17–18%.
So immediate entry into high-growth energy sectors. Interesting.
Very. And then just a month later, end of July, they signed another deal. This time for a controlling stake, about 40%, in an Israeli company called Unitronics.
Unitronics. What's their focus?
Industrial automation and control systems. Think PLCs, programmable logic controllers, HMIs, which are human-machine interfaces, VFDs, servo drives. They even have SaaS solutions and IoT, industrial Internet of Things stuff.
So moving into factory automation, essentially.
Yeah, and more. The price tag for that stake is about 403 crore. Unitronics is global, big in the US and Europe, and get this, their EBITDA margin in 2024 was around 30%.
30%? Wow, that's high.
It is. So buying Unitronics isn't just adding products, it's like instantly acquiring a high-margin global business with established channels in key markets. Very efficient M&A.
Okay, so let's process this. What does this all mean for their electronics division, ILJNN?
I mean, it's a massive shift. They're moving way beyond their traditional areas, consumer electronics components, hearables, wearables, telecom parts, auto meters, defense, and jumping headfirst into these really high-potential, high-margin industrial segments. BSS, EV charging, industrial automation.
Right.
You combine these acquisitions with their fast-growing PCB assembly business and the big expansion in making the bare PCBs themselves. It really feels like they're laying the foundation for, well, a completely different scale and type of business for this division. It's a fundamental reshaping.
Definitely sounds like it. Okay, let's shift gears again. There's a third key division, railway subsystems and defense. Smaller, but strategic.
Yeah.
How did they do in Q1?
Right, smaller revenue base, but growing. Revenue was 123 crore, up 29% year on year.
And EBITDA?
Operating EBITDA was 22 crore. That's up 8% year on year. So lower EBITDA growth compared to revenue in this quarter for this segment.
What drove the revenue growth here?
They said it was mainly product offtake, especially for metro rail projects. You know, lots of metro expansion happening across India. And management sounds really confident long-term. They point to a healthy order book, and they keep adding to their product range.
What kind of products are we talking about?
Things like pantographs, the connectors on top of trains, couplers, gangways between coaches, doors, driving gears, brakes, all critical stuff for modern trains. And that JV they have with Yuchun Machinery, it now includes brakes as well. They expect to start product trials for those brakes by September 2025. So another new product line coming through.
Okay. And are they expanding capacity here too?
Yes, the new Sidwal Greenfield facility, Sidwal, is one of their railway-focused subsidiaries that's apparently progressing well. Should start operations by Q4 FY26, similar timeline to the Hajir Electronics plant.
Now, they've set a pretty ambitious goal for this division, haven't they? Aiming to double revenue in 2 years.
They have. That's definitely ambitious.
What are the main hurdles or risks in hitting that target? And what should people watch for?
Well, doubling revenue in 2 years is aggressive, no doubt. Especially in railways and defense, where projects can have long lead times, complex tendering processes.
Right. Government contracts can be slow.
Exactly. So navigating those processes smoothly is key. Also, scaling up manufacturing for these specialized high-spec components needs careful management investment, skilled people, maintaining quality. For listeners, the things to watch would be announcements of major order wins, especially from new projects or maybe even new customers. And critically, hitting that Q4 FY26 timeline for the new Sidwal facility starting up. Any big delays there would make doubling revenue much harder.
Okay, that makes sense. So let's pull it all back together now. The big picture. The MD said these focused strategic initiatives position us well to enter the next phase of the company's growth.
And I think this quarter really shows that in action, it's not just good numbers in isolation, it's the execution of a clear strategy. Diversify into high-growth areas like BSS, EV charging, industrial automation, while also strengthening the core businesses like durables and railways.
It's a two-pronged approach.
Absolutely. And underpinning all this ambition is capital. The board approved raising funds up to 2,500 crore. That needs shareholder approval at the AGM on August 11th. but it signals the scale of investment they're planning for these big strategic moves.
Yeah.
It's not cheap to transform a company like this.
No, definitely not. So if you're trying to understand Amber's future, what's the main takeaway here?
I'd say it signifies a company that's not just reacting, but actively shaping its own future. They're using both organic growth, building their existing businesses, and these really quite bold inorganic moves, the acquisitions to expand their horizons. The Amber Enterprises of tomorrow looks like it might be quite different from the one many people still picture today. Much more of a diversified, tech-focused industrial player.
So summing up our exploration of Amber's Q1 FY26, it really is a compelling story. You've got the strong financial results, yes, but layered on top is this ambitious strategic expansion into new, high-potential fields.
Which leads to a final thought, maybe something provocative for you to consider. Given this rapid diversification, these big strategic buys into high-tech, high-growth areas like battery storage and industrial automation, how might this fundamentally change Amber's identity and how the market sees them in the next few years? Could they move far beyond that traditional consumer durables tag to become seen as, well, a diversified industrial tech powerhouse?
That's definitely something to think about. How perception might lag reality during such a transformation. We encourage you to keep an eye on these evolving sectors and how companies like Amber are navigating them. Thanks for joining us on this deep dive.